Have you ever glanced at a Singapore stock soaring to a 52-week peak and instinctively thought it was too late to buy? A common sentiment among investors in Singapore and Southeast Asia, who often perceive buying at the top as risky. Though this isn't always the case, as sometimes a stock at its high is just beginning its upward trajectory, particularly when underpinned by strong fundamentals. And today we'll explore how to distinguish between fleeting hype and genuine opportunity by dissecting 5 Singapore stocks currently hitting their 52-week highs to determine if they remain buys or warrant caution, offering a straightforward method to look beyond the excitement and make more informed decisions using real-world examples from our local market. Hey friends, welcome back to the channel. I'm Iggy, and I've been covering a range of wealth-building topics including stocks, finance, CPF, and more, with the Investing Iguana ranking 8th in the 2024 Influential Tigers by Tiger Brokers, boasting over 850,000 reads and 53,000 likes, and having produced over 800 videos amassing more than 350,000 watch hours as of February 2025, while also focusing on regional and global economic trends. So let's dive in and examine 5 Singapore stocks at their 52-week highs. But to add a twist, we'll start with the second best story, then the best, followed by the third, and so forth, to discern which companies possess genuine staying power versus mere hype. Let's begin with Singtel, Singapore's largest telecommunications company, whose share price has risen 22% this year, currently trading at $3.76, just shy of its 52-week high, driven by steady revenue at $10.6 billion and an 11% increase in net profit to $1.9 billion, with a dividend guidance of 16.5 cents per share, yielding approximately 4.4%, boosted by strong performances from its Optus and NCS units and effective capital management enhancing investor stability. While many Singaporeans view telcos as unexciting, Singtel's turnaround is significant, offering an attractive dividend yield, especially for income-seeking investors, akin to a reliable MRT train that ensures safe arrival. Though with the price nearing analyst targets, short-term upside may be limited, making Singtel a potentially suitable choice for those prioritizing stability and regular payouts, prompting the question of whether you've ever bought a stock solely for its dividend and its subsequent performance. Now, let's turn to the best story on our list, ST Engineering, or STE, a company operating in aerospace, smart city solutions, defense, and public security, whose share price has surged nearly 58% this year, reaching a new high of $7.42 before settling at $7.35, fueled by an 11.6% increase in revenue to $11.3 billion, a 19.7% rise in net profit to $702 million, and a record order book of $28.5 billion, with the dividend raised to 17 cents per share and an 18-cent guidance for 2025. STE's progressive dividend policy suggests potential for higher payouts if profits continue to grow, comparable to a Kopi uncle whose booming business allows him to add more cups to his tray and share the profits. However, with the share price at a high and yield below its historical average, new buyers might consider waiting for a pullback before investing, raising the question of whether you would buy a stock at its peak if the business continues to expand or prefer to wait for a price correction. Next is Singapore Exchange, or SGX, Singapore's sole stock exchange, with its share price up 12.7% this year, trading at $14.36, just below its 52-week high, supported by a 15.6% increase in revenue to $646 million and a 20.8% rise in net profit to $340 million, alongside an increased dividend of 36 cents per share, yielding 2.6%. SGX is introducing new products like Singapore Depository Receipts and attracting more overseas brokers and ASEAN investors, with management targeting 6 to 8% medium-term revenue growth, positioning SGX as a steady and reliable, though perhaps not the most thrilling, bridge between investors in the Singaporean market, offering stability and some growth, albeit with a lower yield compared to other blue chips, prompting a reflection on your investment approach, whether you prioritize steady income or chasing growth. And let's discuss Food Empire, a company producing instant beverages and snacks sold in 60 countries, whose share price has climbed 37% this year to $1.36, just shy of its all-time high, driven by a nearly 12% increase in revenue to $476 million US, although net profit has decreased by 11% to $50 million US, with a dividend of 8 cents per share yielding 4.7%. Food Empire is expanding its Asian presence with new production facilities in Kazakhstan and Vietnam, which could drive future growth, but the recent dip in profits warrants attention to upcoming results, making this stock cheap on earnings with a solid yield, yet requiring monitoring for a profit rebound before significant investment, akin to buying discounted durians where the next batch's quality determines the value, leading to the question of whether you are a buyer on dips hoping for a turnaround or prefer proven winners. Last but not least is Sheng Siong, the supermarket chain with 77 stores, whose share price has steadily risen by 8% this year, recently hitting its 52-week high, backed by a 4.5% increase in revenue to $1.43 billion, a 2.6% rise in net profit to $137.5 million, and a 20% increase in free cash flow to $200 million, with a dividend of 6.4 cents per share, yielding 3.6%. Sheng Siong, having obtained 8 new stores since 2024 and planning at least 3 more annually, with 8 additional tenders pending, represents a classic defensive play characterized by steady growth, strong cash flow, and reliable dividends. Unflashy but dependable, like a consistent morning kopi peng, prompting consideration of whether you have a staple stock in your portfolio for peace of mind. Zooming out, it's crucial to avoid blindly chasing highs, and while stocks at 52-week highs often exhibit strong momentum, always verify the underlying fundamentals by examining rising profits, cash flow, and dividends, remembering that in Singapore's market, despite the potential for hype, numbers provide an objective assessment. Focus on yield and value, and with blue chip yields potentially decreasing as prices increase. Ensure the dividend yield still aligns with your investment goals, noting that Singtel and Food Empire currently offer higher yields than SGX or STE. If a stock is nearing its target price or historical high, consider waiting for a price dip before buying, as patience can be rewarding, similar to anticipating the Great Singapore Sale for better value. Diversify your portfolio by combining defensive stocks like Sheng Siong with growth-oriented names such as STE or Food Empire to navigate both market upturns and downturns. Stay informed about company updates, earnings reports, and analyst insights, as market dynamics can shift rapidly, by setting up alerts or following reputable financial news sources. While new highs can be exciting, thorough due diligence is essential, assessing the company's continued growth, the fairness of the price, and the suitability of the yield for your needs, utilizing available tables and charts as guides. Remember that investing is a long-term endeavor, so remain curious and informed, and let's continue to grow together, considering which of these 5 stocks might fit your portfolio, or if you have your own favorites to share in the comments, as your stories and community insights are valuable. If this video has been helpful, please like, subscribe, and share it to support the channel's growth. And for more guidance on selecting Singapore stocks with strong dividends, check out the video on building a dividend portfolio in Singapore. Thank you for watching, and until the next time, stay invested, Iguana style.